Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, and I am joined with Brianna Valesky here, and we're going to interview DJ Paul. He is co-chair of the Crowdfund Intermediary Regulatory Advocates. That's a mouthful. How you doing this morning, DJ?
I'm fine. How are you this morning?
We're doing good. Just could you tell us, starting out, explaining the difference between crowdfunding and crowdsourcing to get things started?
Sure. So crowdsourcing is it's a broader term that basically it means when you're tapping a crowd or a large group of people, usually on the internet, to come up with an answer to a question or a design, but it's not specifically monetarily related. It's certainly not securities related. We usually use the term crowdfunding when there's money being exchanged, including when buying or selling securities. Does that make sense?
Sure. Okay, and could you just give us a little bit of your background, in the financials, in the markets, and currently what you're doing?
Yeah, sure. When I got out of school, I went to Wall Street, like a lot of 22-year-olds who are are interested in bettering themselves in some respect or another. I did that for a few years. I was a mortgage-backed securities trader and salesman, and I left I did that for a couple of years. I left. Actually went to Hollywood and produced films and television for about 15 years, and then got dragged back into financial services. I was asked to help a fledgling crowdfunding company help advocate for the passage of the Jobs Act. So I went to D.C. and threw my shoulder into trying to get that bill passed, which we did, and that's how we got what's known as Titles 2, 3, and 4, which are the three parts of the Jobs Act that deal with crowdfunding and with securities reform that allows it to happen. Now I work for a company called Propellr, which is a real estate crowdfunding platform, and I can tell you guys more about that if you're interested.
Yeah, sure. Go ahead.
Yeah, so Propellr is only for accredited investors, and we'll probably get into that distinction a little bit later. But we raise money, usually between 5 and up to 150 million for commercial real estate projects. Our primary customers or the purchasers of our securities are institutionals, hedge funds and family offices and private equity, but we always reserve a piece of all of our deals for individuals, high net worth individuals known as accredited investors. And they invest right alongside of our institutional investors at exactly the same terms and the same tier, the same tranche, and at the same rates. So that's a pretty good deal for the individual investors who get in on those opportunities. And those are opportunities that would otherwise not have been available to individual investors, before our involvement in it.
Let's talk about the term accredited investor and what right now
Sure.
defines that parameters. And I believe that you're involved in a committee that perhaps is going to change that designation.
We're going to certainly try. Yeah, I mean the committee is the small and emerging company advisory committee, which has been formed by the Securities and Exchange Commission. And our first meeting is actually a week from today, so I'm looking forward to that. But the accredited investor definition has been pretty much unchanged since about 1982. And for individual investors, that means that they have to have either net worth of in excess of $1 million, and or $200,000 a year in income, last year and anticipating in future years. If they don't have that, then they really are not allowed to invest. There are some exceptions, but I won't get into the details of that. Really, that's the baseline for it. And that definition, as I mentioned, has been relatively unchanged since 1982. It's problematic because that basically kicks out 98% of Americans. Only 2% of Americans conform to that definition. And the idea of an accredited investor was really never supposed to be, from the beginning, according to Congress, going back to 1933 and the Supreme Court in the 50s, was never supposed to be just rich people. It was supposed to be people who could understand the nature of the investment and could fend for themselves, who could evaluate an investment and decide whether or not the risk was appropriate for them. And certainly, I guess someone who can take the financial hit is a kind of sophistication, or at least a kind of ability to fend for themselves. But what's been lost is that there's some very smart people who maybe only make $175,000 a year. Heaven knows there are some very dumb people that make, $500,000 a year. So the notion that simply your income, or let's say an inherited net worth in excess of $1 million, makes you smarter, makes you able to evaluate an investment, seems to defy logic. So what we're trying to do is expand the definition so that it captures people who are not merely rich, but are also sophisticated and smart. So that's the broad initiative that some of us are working on right now.
Okay, going back to your company and the investments that you make. So, are they necessarily liquid investments? I mean, let's say you are an accredited investor, you decide, put $500,000 into one of these projects. I mean, first of all, what kind of return are you looking at over what period of time, and what is the liquidity? I mean, what if for some reason you have an emergency, or you have a change of heart? I mean, what are the covenants to be able to liquidate? I mean, I know from my experience in the real estate market, I mean, it looks pretty good when you get in, and you look to hold for 5, 6, 7, 10 years. But when the dynamics change, as opposed to the stock market, there's not really a bid you can hit.
It's an excellent question. It's something that I'm really glad that you're hitting on the secondary market aspect of it, and I'm looking forward to responding to that. Let me answer the first part of your question, which is what do the deals look like? What are our returns? They will, of course, vary. Most of our deals are actually debt and preferred equity, so they're often current pay and they have a coupon associated with them. We do some equity deals, but for the most part, they're current pay deals of some kind. And the returns are, somewhere between 10 and 14%. I think we're going to have a deal coming out pretty soon that is actually going to be maybe a 15% coupon. So we're talking about, substantial returns, particularly in a fixed rate environment where, I don't know, people with their money in a money market are probably getting less than 0.5%. So that's pretty good. The term, to answer your other question, they're anywhere from, I guess, as short as 12 months and as long as 5 years, with the duration falling somewhere in the middle, probably 2.5 years. And as for liquidity, you're right, of course. These are private placements, so they're never going to have the liquidity of a publicly traded offering. Having said that, the scenario that you described, the hypothetical of like somebody gets into trouble or has a change of heart, we have, because we do these as securities offerings, and we actually get CUSIPs issued for them. And a CUSIP is like a serial number for a security. So we are able to secondarily trade these in limited amounts. We did have a situation, much like the one that you described over the summer, where an investor, for personal reasons, had purchased a couple $100,000 of something and had asked if they could be taken out of it. And, our offerings are usually oversubscribed by at least 1.5x, and oftentimes as much as, 3 times oversubscription. So we had no problem placing that piece for that investor with someone else who wanted it, who didn't get their full allocation perhaps on the first. So we were able to do that twice for $200,000 block. So it can be done. We are doing it. And we, like you, we agree that it is very important to be able to offer some kind of bid to be hit, as you put it, so that people can at least, find some price discovery and get a little bit of liquidity, which is unusual in the private placement market. But we certainly agree with that. And that's another thing that we're working to develop. We think a robust secondary market actually helps the primary market. More people will be more willing to buy the securities if at the outset if they know that there's at least some way for them to get out later on.
DJ, this is Brianna. Can you tell us a little bit about the process of investing through your platform?
Sure. I mean, we don't do a lot of advertising. In fact, we don't do any really. It's mostly word of mouth, and sometimes I'll do an interview like this, and somebody will say, hey, that sounds like a good idea. So what do I do? And they'll go to our website. They'll broadly see what it is that we do, and they'll request an invitation. They will then be asked to onboard themselves to give us their information, and to make sure that we make sure then that they are in fact an accredited investor. As I said, we can only sell our stuff to accredited investors. And then once they're onboarded, they can look at our deals when we have them. And then as to how they actually effectuate the transaction, they'll review the deal. They'll say, yes, I'm interested in investing. They will request an allocation. And then when the deal is allocated, they will be offered an allocation. Wire their money in much the same way that you'd purchase any security on the internet. Does that answer your question? That's. I mean, I can get into more detail, but I think that's the broad sense of how it happens.
Right, absolutely. So what are the possible returns, and why would someone invest with them over investing in REITs?
Well, a REIT is a pool of funds. Well, first of all, I think the returns are comparable, if not in some cases better. But remember that a REIT is a pool of security, rather a pool of properties managed by other people. Hopefully, you trust and are relying on the expertise of the people that are managing the trust. There are different tax consequences for investing in REITs and investing directly in real estate, but the significant difference between investing with us and with a REIT is that you're investing in a specific project, one that you can look at. What you're going to know the address. You're going to understand the specific underwriting for that project. What the business line is, what the plan is, and then you as an investor can evaluate: do I like this investment? Do I want to invest in it? It's roughly equivalent to a REIT is more like, let's say, the equivalent of a mutual fund, and what we're offering is an individual entity, an individual stock. So that would be the analogy to, let's say, more equity based. Does that work?
Yeah, it does. And now I guess we can get to the whole heart of the matter here and why people would look at your site or look to REITs or look for alternative investments, and that's all predicated on interest rates, right? Where are you going to get
Correct.
where are you going to get your best return? So, doing what you do, being in the real estate market, obviously there's, the money, the financing that you have to pay to do the deals. I mean, your deals aren't all cash deals, right? I mean, you are doing some financing with them.
I'm not sure I understand. I mean, all our deals often are the financing that are offered to a project. So if you're asking if our deals are, if the investments themselves are levered, the answer is no.
Okay. No,
basically, we're go ahead.
No, I mean, I'm just saying that this is, I mean, are you able to go into these deals all cash and then not have to go to the banks for any kind of excess funds? Or are these the funds being put up to go to the banks in order to get the cash to do the deals?
Well, we will do for a given real estate project, if I understand your question. If I don't, please correct me. But the other side of it is, a real estate developer will come to us with a project and say, I need X number of dollars in order to do this project. And of course, we expect our developers, our sponsors, to come to the table with skin in the game, with cash in the deal. Sometimes they need more equity, and they always need debt. And usually we step into the role of what would normally be considered a bank if banks were actually lending here. So we will offer the full debt stack to the developer, and then that's the piece that we will then push out to our high net worth individuals and our accredited investors and our institutional buyers. But I'm not sure I'm answering your question.
Yeah, no, you've answered that correctly. And just finally to wrap things up here, interest rates,
Sure.
Right? You're keeping an eye on the interest rate market. People are looking for alternative investments. A lot of trepidation about what the Fed's going to do next year with interest rates. Obviously, if interest rates starts to move up, that's going to be competition in your business. Just your take on the short-term and long-term outlook for interest rates.
Well, I mean, long term, I don't think that there's ever been an economy where so much money has been pumped into it that didn't have inflationary pressures. And inflationary pressures are going to correspond with, at some point, higher short-term interest rates. The Fed has to raise rates at some point. Whether that's in a year or 18 months or 24 months, I don't have a crystal ball that isn't cracked, so I can't guess with respect to that. But I do think that it's a fair assumption to say that interest rates are not going to stay effectively, zero, a Fed funds rate of effectively zero indefinitely. When that happens, yes, of course, that'll put some pressure on long-term rates to go up, and there will, the banks will then be potentially competitive with us. I don't know, however, that interest rates alone are the issue here. There's also underwriting standards. There's a whole category in the alternate finance debt market, which you've referred to, that the big banks are simply not as facile in participating in, and we are. That is what we do. While we are currently limited to real estate, we are also looking at taking on other types of alternative assets, let's say asset-backed securities or perhaps student loans, other things that trade at a larger spread than, let's say, treasuries or traditional debt instruments, so that we can add some issuance and liquidity to those aspects of alternative financing as well. So
Okay.
we agree with you. We do, of course, anticipate that rates will go up, but we think that there's going to be a market here for other types of investments as well.
Okay, DJ Paul, co-chair of the Crowdfund Intermediary Regulatory Advocates, also chief strategy officer at Propellr, a New York-based real estate investment crowdfunding platform. Joining us today on Benzinga's Pre-Market Prep, brought to you by MarketFi. DJ, thanks a lot. Have a good day, and look forward to talking to you again soon.
Thanks for having me. It was a pleasure.